The year is 2026. Banks, investment giants, and global financial institutions are quietly moving billions of dollars into something called tokenization. Names like BlackRock, JP Morgan, and Societe Generale aren't just experimenting, they are building the framework for the on-chain financial system. Yet, for the everyday investor, these developments feel distant. Most people assume that blockchain and DeFi are still for tech nerds and crypto enthusiasts. But here's the truth. The system being built today will dramatically change who can access financial markets tomorrow, and you don't need millions to start participating. 1. Why institutions are going on a chain. Traditional finance has long relied on centralized intermediaries, banks, brokers, and clearinghouses. These institutions manage transactions, custody, and compliance. But they also slow everything down and make investing expensive. Now, these same institutions are experimenting with blockchain because it offers transparency. Every transaction is publicly verifiable and immutable. Liquidity. Assets that used to sit idle can now be traded fractionally, instantly, and globally. Efficiency. Automated settlement removes the middleman, lowering costs. For example, BlackRock has begun exploring tokenized ETFs and real-world assets on-chain. JP Morgan has its JPM coin, a blockchain-backed token for institutional transfers, now evolving to handle more asset classes. Societe Generale has issued tokenized bonds, allowing investors to buy fractions instead of entire bond lots. These moves aren't just experiments, they are laying the foundation of a new financial infrastructure that the public can eventually access. 2. What this means for everyday investors. So what does all of this mean for someone with $100 or $1,000 to invest? In short, it means the door is opening. You no longer need millions to buy real estate or corporate bonds. Specialized brokers for rare collectibles or private equity, weeks of paperwork and bank approvals. Tokenization allows you to own fractions of real-world assets, trade them instantly, and earn proportional returns. Some examples of what's possible today: fractional real estate. Buy shares of apartments in New York, Miami, or Paris without buying the entire property. Platforms, Realty, Solid Block. Tokenized bonds and treasuries. Invest in government bonds or corporate debt on-chain. Platforms, Securitize, Tokeny. Collectibles and luxury assets. Own fractions of rare art, luxury cars, or even sports contracts. Platforms, Curio Invest, Mecenas. This is financial inclusion at its finest. Anyone with internet access can participate. 3. How to start. A practical guide. Let's break it down step by step for beginners. Step 1. Get a wallet. A digital wallet is where you store your tokens. Options: MetaMask, Trust Wallet, Coinbase Wallet, Argent Self-Custody Wallets. You control the keys, full control, more responsibility. Custodial wallets. Platforms manage security for you. Easier for beginners. Step 2. Fund your wallet. Most tokenized assets require cryptocurrency as a medium of transfer. Buy from reputable exchanges like Coinbase, Binance, or Kraken and transfer it to your wallet. Step 3. Choose a platform. Pick a platform that aligns with the asset type you want. Real estate, Realty, solid block bonds and treasuries. Securitize, Tokeny art and collectibles. Curio Invest, Mecenas. Step 4. Buy your first token. Select the asset, choose how many tokens to buy, and execute the purchase. Congratulations, you now own a fractional real-world asset on-chain. 4. Security and custody. Holding digital assets comes with responsibility. Self-custody. You hold private keys, full control, but losing the keys means losing access. Managed custody. Platforms or banks store your assets securely for you. Future integration. Major banks are exploring secure custody solutions for tokenized assets, bridging traditional finance and blockchain. Security isn't just technical, it's also regulatory. Platforms and banks must comply with strict KYC/AML standards to keep your investments safe. 5. Why this changes everything. Tokenization is more than just a trend. It changes how we access, own, and trade assets. Accessibility. Anyone, anywhere can invest in assets previously reserved for the wealthy. Liquidity. Hard-to-sell assets like real estate or bonds can now be traded instantly. Transparency. Blockchain records are tamper-proof and publicly verifiable. Lower costs. Fewer intermediaries mean smaller fees. The result? A financial system that is open, fair, and efficient, rather than opaque and restrictive. 6. Real-world success stories. Real T. Investors earn proportional rental income on tokenized properties. Securitize. Global investors can buy tokenized corporate bonds and treasuries. Curio Invest. Tokenized luxury cars and collectible assets are now tradable worldwide. These examples show that tokenization is not futuristic. It's already happening, and institutions are actively building it. 7. Why you should care. Even if you don't have millions to invest, these changes matter because the world of finance is becoming digital. First, traditional barriers are disappearing. Early adopters stand to benefit from higher efficiency and access. If you wait, you might be left behind. If you act now, you can start exploring these opportunities safely and gradually. Regulatory compliance and why it matters. One of the most important but often overlooked aspects of institutional tokenization is regulatory compliance. Big players like BlackRock, JP Morgan, and Societe Generale aren't just experimenting for fun. They are building compliant, legally approved on-chain systems. This means every tokenized asset is fully regulated under local and international financial laws. Investors can participate safely without risking accidental illegal activity. Platforms must follow KYC, Know Your Customer, and AML, Anti-Money Laundering rules, creating a secure and transparent ecosystem. It's not hype, it's methodical, regulated, and growing rapidly. And the best part, everyday investors can start participating with small amounts, simple wallets, and compliant platforms. 2026 isn't just about crypto coins, it's about digital ownership of real-world assets